Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Equity Group and Appleman Properties. To the listeners that are out there right now listening to us, we will have a few quick questions and answers that you can put in. If you've got questions, we want to get answers to anything you have. But today we're joined with Sujay. Sujay is a writer, is a successful entrepreneur with expertise in hospitality, and is talented at raising capital. They have also advised startups and are respected for their ability to identify emerging trends and opportunities. Sujay, we're excited to have you here today. If you could just tell us a little bit more about yourself.
Yeah, man. Thank you so much. It's a pleasure to be here. I'm excited even for the questions. So let's get it started. So again, as mentioned, my name is Sujay, last name Mehta. I'm from Columbus, Ohio. I'm a Buckeye at heart, went to Ohio State. It's crazy because I actually started off my journey thinking that I'm going to be a physician. And a lot of cultural pressure, a lot of Indian people going into the medical industry. So we had a lot of cultural pressure, that kind of pushed me to go into, the medical track. And as I was kind of going through that journey, realizing how much you have to put in and how long it is and how much of a time commitment it was, I started thinking about other things that I could do with my time. And, I stumbled upon real estate. And so that's when, we got into real estate. I started doing developments, really just started into hospitality from the get-go. And now, we have a portfolio of hotels. We franchise with Hilton, Marriott, Hyatt, Choice, Wyndham, Best Western. The list goes on. So we're franchised with a good amount of the hotels. And it's funny because a lot of people drive down the road and they see these hotels and they think these are just owned by these franchises, but they don't realize that, people like us who are real estate investors can actually purchase the asset, run the real estate, run the operations, and, take that cash flow, take advantage of, the steady business that's coming in. So, it's kind of like short-term rental, as residential real estate is to multifamily, the Airbnb short-term rental game is to hotels.
Yeah.
So
That's huge. So you're in general partnership, and your general partnership goes out and acquires these franchises, and essentially you bring your investors in. And as far as the operating part, though, you've got an operator that's actually considered, we're not going to say property management because they're operating the hospitality. Is that correct?
Yeah. No, so we actually also operate our hotels, right?
Nice.
So we have an on-site GM, and then as you start to scale, you can afford having layers in between. And so we do have some district managers and things like that, and so we're able to start building those layers. But when we started, it was a GM, and then me on top of the GM, and the operations part is definitely fun, quote unquote. So it's a little bit of a dynamic process. You have to be constantly adjusting. You have to know how to deal with employees, and it's a lot of fun. And that's how you maximize your profit margins, right? Yeah. Through the operations. And there is ability to hire a third-party management company. Yeah. So you would give them a fee of 3, 4, 5%, depending on what the services are. But as a GP, you can purchase the asset, give it to a third-party management company, and then you would have to asset manage, similar to multifamily.
Yeah, I like that you're vertically integrated. That's you can execute your business plan. You can really double down on your whole model because you're controlling the expenses. You're controlling the cash out versus just the making sure the property is performing. You're in total control, and that's huge. And it's the hardest part of the deal is being
absolutely. And in the world we live in today, where social media, Instagram, everyone's putting their portfolio online, and me as well, right? And for a long time we didn't do anything on social media, we didn't do anything online. It was real G's move in silence like lasagna, right? So just kind of do your thing. You don't need to share, but with this wave of social media, and it's awesome, it's amazing, so many opportunities come with it, people get distracted and they just think scale. And in order to scale really quick, they hire third-party management, and some third-party management companies are great, but sometimes when you scale so quick and you're not organized in the operational aspect, you lose a lot of the benefits of owning real estate, right? So you let a lot of costs slip through your hands. There's a lot of variances that you should have been able to control early on. And, once you hire someone at, 150,000, you can't bring it back down. So it becomes difficult to mitigate that once it slips through your fingers. And so, I think it's a little bit of the world that we live in that you alluded to, just now, that the world that we live in kind of pushes us to scale really quick, really fast, and we lose that. So I think it's really important, and that's one of the key things that we do sell when we do raise capital, is that we are operators ourselves. We invest into our own deals. We put our money where our mouth is, and we're going to make sure that this thing is profitable. If I have to be there physically for some time and make sure that we get the operation in check, I mean, that's what we'll do. So
that'd be horrible to live in a hotel and have to make sure that everything's going good.
Right.
But so out of all of the asset classes, you've got industrial, you got self-storage, you've got multifamily, residential, but why hotels?
Yeah. So hotel has a unique component to it. And it's funny that it's people sleep on it, no pun intended, but but it's really a sleeper class. And the beautiful thing about hotels is that operational heavy component. The reason why people are getting into Airbnbs and short-term rentals is because you rent out the rooms every single day, and it's a business. It's not just a passive real estate asset that you purchase, you park your money, and you get 6% or 8% a year, but you have this operating business component where you're making money every single day. And so because of that, the cash on cash return is excellent. And short-term rental, Airbnb versus hotels, you're able to scale, right? You have 100 rooms under one roof versus 100 properties in so many different states and cities that you have to travel to. So you're able to manage a hotel a lot easier because you have more doors under one roof. But again, it's the cash flow, right? So that business component really pushes cash flow, and you're still able to take advantage of all the tax benefits that you get with real estate, the depreciation. In fact, hotels, the bonus depreciation for hotels is significantly higher than what you would get for multifamily and
I did not know that.
family homes. Yeah, because you have, what bonus depreciation does is it accelerates the depreciation of furniture, especially. So with hotels, we have so much furniture in the rooms. I mean, the beds, the windows, the blinds, the desks, all those things are depreciated and accelerated. So you're able to take advantage of the tax benefit. The real estate appreciates over time. If you're a good operator and you're willing to put some time and effort and some sincerity into managing your asset, you can mitigate the costs, and that dollar for dollar, it impacts your bottom line right there. Right. So there's that huge business component opportunity to the hotel industry.
Yeah, I had a call this morning. We were going over a cost segregation study on one of the other properties we have, and it was said that if we're improving the land, as far as like putting a playground in or a fire pit or a dog park, that we would be able to get even more depreciation off those little things as well. So
Yeah.
there's caveats, but depreciation is truly the magic of real estate. If it's used properly, it can your returns can be substantial. Just on that one component.
Especially when you're raising capital, right? So
Yeah.
you're raising capital and you think, oh my God, I have to raise $2 million, and you're nervous, but then you offer this, 1-to-1 depreciation. And it doesn't always happen, right? It depends on your asset, how old it is. And there's so many components to it. But sometimes we get, if we invest $2 million, we get $2.5 million of depreciation. Yeah. So it's when you sell that to an investor, I mean, that's just a cherry on top. We never make that the primary point of our raise, but it's always a good closer.
Well, and it's never even underwritten into the deal. It's just icing. So the underwriting is just the performance metrics of cash flow. So it's we agree.
Yeah, absolutely. I mean, it's a closing point, right? When you have somebody on the fence, you say, well, hey, think about this. Once you give your money up on April 18th, you're not getting it back. Instead, why don't you let it work for you? So
100%. Can you share a specific project or an investment that you are particularly proud of in a hospitality industry, and what made it successful?
Yeah, absolutely. So there was a hotel. It was in a secondary or even tertiary site. So when we say that, it's a little bit more rural. It's not the Orlando, Florida, or the
Yeah.
Naples, or the Miami, or the New York, typical primary market that you would think of. So it was a little bit secondary, tertiary. It was in 2019, December 13th is when we closed on that deal, right? And so obviously end of 2019, 3 months later, COVID.
Yeah.
And hospitality, as many of our listeners probably already know, was one of the biggest impacted asset classes during COVID. Obviously, all businesses were greatly affected, but travel especially. And so we were extremely nervous with that asset. We had just bought it. We didn't have much equity in it. We hadn't paid down the note, right? So we hadn't paid our mortgage down so much that we could reach out to the bank, ask them to, give us 6 months of severance or whatever it is, right? We weren't able to do that. And so, when COVID hit, our occupancy dropped to almost 20%. I remember I was looking at the forecast and, I would look a week ahead and I'm seeing 1 or 2 or 3 rooms in the coming week, right? And so, we were definitely nervous. We were, trying to figure out what we can do, how we can, decrease our expenses, how we can. So what we did was we shut down 2 floors of the hotel. So now we don't have to run, the AC or the heat in those 2 floors. We could turn off the lights. We're taking extreme measures. We're unscrewing light bulbs. You have to do that, right?
Yeah.
You have to do that at times. And so, we were lucky. We went out, we got some, low cost, we got some low cost business that was, construction workers. They really didn't need much. We didn't have to do housekeeping for them every single day. So we were able to mitigate expenses that way. But they brought a group of 15, 20 people in their crew and took up 10, 15 rooms in the property and helped us kind of float through that time. And, breakfast was closed for us. So some of those things helped us with our costs, and we were able to, even though it was only $60 a night versus, the $9,800 that we were expecting, we were able to float through that time. But with that asset, what happened was it was $1 million investment, and it wasn't the prettiest hotel. It wasn't the brand new Hilton or the brand new Marriott that we all love to see and put on our Instagram or our YouTube. But it was an older 22-year-old asset. It was $1 million investment. Turns out that towards the end of the year, because it was a secondary, tertiary market, it was right off the highway. So when everybody was tired of staying at home, when everyone was tired of cooking at home every single day, they started driving because, flights still, a lot of flight routes were canceled. People still felt unsafe being in an enclosed plane with, a bunch of people. So people would drive and they would come off the highway and stay at our property. And so we picked up tremendously at the end of 2020. And some of those cost mitigation steps that we took, we kept in place. Yeah. We were able to increase our NOI from what was $300,000 to $850,000.
Oh,
so now going into 2021, 2022, we're making 85% return every single year, and that's cash flow. Wow. On top of that, we're paying our mortgage. We're seeing that principal, that equity pay down on our mortgage. We've increased the value of the asset. So tomorrow, if I go sell the property, I'm selling it for double the price, not double our investment, double the price. And so, we crushed it with that asset, and it's been 3.5 years. So
that's wild that the growth of the NOI just off of your expense, and that's the whole thing with entrepreneurship, is thinking creatively and constantly being able to evolve in different issues that may arise, and that's an ever evolve. Issues come up every single day. It's just how are you taking care of these? Where are you combating? It's being able to pivot quickly.
Yeah, I always say that as an entrepreneur, you have to be on your toes. You have to be able to cut left, cut right, in a spur of a moment and juke on a dime, right? So you always have to be thinking forward. And even when I saw Dollar General, they increased their price from $1 to $1.25. When the dollar store is increasing their prices and the Fed is still saying inflation is transitory, it's saying something. And so we were able to pivot, increase the rates, start pushing the rates, even on our regular customers or corporate customers that are coming every single year. So those kinds of things helped as well. We were able to increase the revenue while still maintaining our costs. And so that helped push the NOI.
That's incredible. So as an entrepreneur, how do you identify emerging trends and opportunities? And I guess the path of progress, how do you see to the future of an area?
Yeah, absolutely. And I mean, I think one of the most important things is being tapped in, right? Understanding what's going on in the global markets. Everything is connected. I believe in the butterfly effect. So one thing happens, it trickles down and it leads to so much more. So when you see these banks failing, for example, right now, how is that going to affect me as a business owner? Right? We have a couple of renovations going on. We have a couple of new construction projects going on. Some we may not have tied down our lending, right? So we don't have our loans, set in stone yet. Now I know that's going to affect me. So before we get started too fast and too quick, I might want to hold off and see if I want to wait 6 months before I start this project. And so there's always things like that are going on, and you want to be tapped into the global market, understand what's going on. In the hospitality industry, location is so important, but location is not as easy as it may be for single family home or multifamily or even Airbnbs, where you just want to be in the most tourist heavy locations. But sometimes hotels, like I mentioned in the example earlier, a secondary or tertiary property that's off of the highway, or it might be next to some other demand generators that we may not think of in our everyday life. For example, Morningstar, if they have a farm somewhere and they're expanding the farm, they have a bunch of people coming in, consultants coming in, and they're not staying in that area. They don't want to live there. They want to live in the cities like the Dallas, Texas, or this or that, or whatever it may be. So they're just coming, they're staying for a month at a time, and then they're leaving. And so there's those demand generators that really make our project or our asset successful. And those are the things that you want to be tapped in when studying a location. You want to understand, where businesses are going, why they're going there. Austin, Texas, for example, once you see, Tesla going there, then Apple, then, all these other businesses are going to follow. Another area that we love is Columbus, Ohio. I mean, it's growing like crazy. And for the last 5 years, we've been seeing that it's one of the fastest growing markets in the Midwest. And so we want to be there, even if we're in a suburb of Columbus. Columbus in general is going to be expanding. And so we want to get in early, and we want to take advantage of that expansion when it happens. So, just being in touch with, what's happening globally, locally, it will really help you connect the dots. And I like to study a lot of history as well, because history teaches you that you can do comparative studies, and it allows your mind to think in that way. So
and history repeats itself at some given point in time. And Columbus is a very hot market. There's some very good economic employment drivers that are coming in. So I definitely agree with you there.
Yeah, absolutely. With Intel and whatnot. So
So how do you approach fundraising for your projects? What's the secret sauce behind that?
Yeah. So with fundraising, I mean, one thing first and foremost is, I've always been honest, and we've always trusted our numbers. And so if our numbers say that this project is not going to work, we don't pursue it. And when you're raising capital, a lot of times investors are looking for someone who is relatively conservative. They've done their due diligence. They understand their numbers. And that's the number one thing for us is we understand our numbers. We say it like it is. Whenever I'm raising capital, the first thing I tell them is, understand the risks of investing, right? And so I take 5 minutes, 10 minutes, 15 minutes and explain all the things that could go wrong. If they're still on the call and they're still willing to listen, then we put out all the pros, all the positives, all the things that are going for us. And when you do that, you build trust. You build trust with your investors. And that's the number one thing for me is that every single one of my investors, if they call me, I'll pick up. I'll talk to them. I'll give them time. And especially when you're starting, building that relationship, building that trust is so important. a lot of times we go to these meetups or these networking events and we talk to someone and we ask them, are they interested in investing? They say yes, but then they're not interested in that project. Do we follow up? Is there a second point of, is there a second touch point, a third touch point? When you follow up with these people, these high network individuals, they may not invest in your first deal, but they may invest in your second or third or fourth deal, right?
Yeah.
And so, raising capital, it's not a 6-month thing, it's not a 2-month thing, 3-month thing, it's a 5-year thing. And so when you're constantly talking to these people, building the relationships, and all of our projects, all of the capital that we've raised is all relationship based.
Yeah.
We have a relationship with every single one of our investors. They know us, they trust us. Today, if something goes wrong and I give them a call and I say, hey, this is what's happening, they say, that's okay, Sujay. We know you're doing everything you can. Don't worry about it. Just let us know how we can help.
So
And
the 506B.
Yeah. Yeah. So, I mean, and now, we, as we grow, we are starting to get into, a little bit more of, the syndications where, 506C, where, they may not, smaller check rights, they may not know us, things like that. But, that's where it starts. And when you have that base, then you have the confidence to go out and do those other things. So,
Yeah. No, I totally agree. That's, going back to your underwriting, you said some very key points, and I'm multifamily focused. I know you're hospitality, but it's still out there is where the sellers are wanting to sell their properties based on a future value on pro forma, and I'll get an OM over, and here's the NOI, here's the in place NOI. How can you tell me that this property is worth more than what it's currently performing? And it's kind of a tug and pull, because I want to sell the property that I've worked hard for based on NOI to the next buyer. I want them to know that there is a value component, that I haven't raised rents all the way to the max market value, but I'm going to sell my business based on how it's performing today, not how you're going to get it to perform in the future. And I think that's one of the most frustrating parts for an operator that we are is buying based on someone else's unrealistic expectations. Well, we just don't buy it, but there would be a lot more buying, I think, if businesses were sold properly.
Yeah. And I think we're facing that so much right now. Like we just had a call yesterday where, someone called us and, they showed us the NOI and they said, but it's mismanaged, but there's all these things happening, but, X, Y, and Z, but with a renovation, you can potentially get this much. Well,
Yeah.
Why don't you just keep it?
There you go.
Do those things, and then sell it to me when you're ready. Because for someone coming in and buying, especially for an operator, we're not buying to make 6% return, right?
Mhm.
CDs right now are giving, 4.5%, 5%.
Right.
So why would we go out, and especially when you're raising capital, you have to take in consideration your investors, and you have to make sure that you're making your investors whole, and it's something that's worth investing in, right? And so we are looking for projects where there is upside. That's what we're looking for, but we're looking to pay for what it does today. And it's funny because the same buyers and the same sellers are looking at it different ways. So when I'm selling my project, sometimes, even I fall into this where like, well, I could probably get a little bit more out of it. And I say the same things, but then when I'm buying, I end up ripping an agent who tries to sell me something on projections. So
I think it's definitely a tug and pull. It's and being on one side of the table versus the other. It's do or don't. But
absolutely,
and it's the value add component. What we've got. Our side of the business is the armpit of the business, getting it to perform, the lease up, the management, the getting it to where we want to reap the benefits at some point. And that's the hardest part. So if somebody's wanting to sell it at a future value, and essentially you're giving up all your equity and your hard work, it's makes it
and it puts so much operational pressure on you when you do that, because your cost basis is so high, your debt service is so high, and you have to instantly actualize that potential. And if you don't do that, then it puts so much pressure on you operationally, and it starts eating into your reserves or your cash flow, and you're not able to distribute and then the slightest change in the market puts you 10 steps back, So that, and I think that's what happened in the last couple of years, especially in, multifamily cap rates were so low, people were overpaying so much. And with the IO and variable interest rates, when things shifted so quick, people weren't able to adjust so fast because, they were stuck already with the high cost basis. So.
Got a question that came in from YouTube from Tim. Tim asked, if I'm wanting to get into hospitality, how would you recommend me get started? I currently have 2 Airbnbs, but I want a hotel.
Yeah, absolutely. So that's actually perfect, because I always say you should have a little bit of, real estate knowledge or business sense before you get into hospitality. And a lot of times what we do is we start searching hotels for sale. And the first thing we'll look at is, Hyatt's or Hilton's or Marriott's, again, because they're the prettiest. But don't fall into that trap. Like I mentioned earlier, sometimes some of the lower, like the economy brands, and I'm not saying to buy a rundown, motel, 10 rooms that you never stay in. I'm not saying that, but look at the choice, look at the Days Inns, look at the Motel 6s, look at the Quality Inns, the Comfort Inns, the Best Westerns, look at those brands. And the first thing I would say is start studying them, right? Start calling agents, start calling brokers, and start having those conversations. Learn the lingo. When you ask 10 dumb questions, they may not sell it to you, but at least you'll learn. At least you'll get your foot in the door. You'll start understanding, what questions are the right questions to ask, and then start underwriting the deals. You want to understand, okay, these 10 hotels, the payroll was 240,000 for an 80-room hotel. So then when you see the 11th hotel with the payroll significantly higher, you can say, oh, here's an opportunity for me to purchase at this price, and I can decrease the expenses and increase the NOI. So you want to continuously start underwriting. I underwrite at least 1 or 2 deals a day, even if I'm not in the market to buy, just so I can understand what the trends are, what's going on, how much has labor increased, energy costs have gone up across the board, and I can better manage my asset efficiently. So, that's one thing is, just jump into it, start taking a step at it, and look at that, those brands. Number 2 is, reach out to me as well. We are launching a coaching course eventually in the next couple weeks. We're going to start seeing who's interested and start launching a coaching course. So, I would love to help, but, outside of that, just start, calling brokers and getting your foot in the door, getting your feet wet. And slowly you'll build upon itself. And yeah, so.
That's a great answer. That's for sure. Looking ahead, what new industries or opportunities do you see emerging, and how do you plan to adapt your skills and expertise to capitalize on them?
Yeah. So one of the things that we're seeing is extended stay. So extended stay hotels are the hotels that have the small kitchenettes, larger rooms. So when you think of extended stay, you could think of the Residence Inn by Marriott, Home 2 by Hilton, Stay Bridge by IHG, Candlewood Suites. Excuse me. These are all extended stay hotels. And with work from home life and, people just wanting a little bit more space and staying for a longer amount of time, we're seeing a huge benefit to the extended stay market, as well as on the cost side, because, when people are staying for a week, they're not requiring that housekeeping every single day, or, our breakfast costs are a little bit less because, they don't expect that same breakfast every day anyway. So there's a lot of efficiency when managing those kinds of hotels. And so, something that we're trying to do is expand our portfolio in the extended stay. Something that Hilton and IHG launched recently is 2 brands, one called True by Hilton and one called Avid by IHG. Those hotels are actually the exact opposite. So they're a little bit more European style, I like to say, where the rooms are a lot smaller, about 250 square feet versus the typical 350 square feet. But they took out the clunky desks that nobody uses in the room. They made platform beds. They made it easier to clean. The closet isn't a separate door, but it's just kind of on the side of the door with a couple hooks. So they designed it such that it doesn't feel as small as it actually is. It does feel a little bit small, but it's for that traveler who's kind of, just needs a place to sleep at night. It has the best quality beds and the best quality TV. They just need a place to sleep at night, but they're not going to be spending too much time in the rooms. And so there's kind of a little bit of this like polarity between the two. And these brands do a lot of research. And so the great thing about aligning yourself with these brands is you get to piggyback off of their research, off of the trends that they see. And a lot of times when you're looking to build a hotel, you can call these brands up and say, hey, what markets are you guys targeting in Ohio or Minnesota or Texas? And they'll have a target list for you, and you can kind of piggyback on that research. So
that's huge. That's a good nugget for anyone to pick that up. If you're calling brands and you want to find out where they want to grow their brand at, they kind of pre-identified certain areas, emerging markets, to where they can. And that's what it's about. That's those are little tidbits of information to help other,
especially on the development side. The great thing about purchasing an asset that already exists is that you have that 3 to 5 years financials that you can look at. So what better insight in trends is it than the revenue just going up from 2 million to 2.2 to 2.4 year over year? If it's increasing, I mean, what more data do you need at that point, right? So
exciting. That's that's what we all like to see, for sure. Awesome. I appreciate your time. Say somebody wants to get a hold of you, they either want to go in your coaching program, or they want to invest in you, or they just want to learn more about you. How can they get a hold of you?
Yeah, absolutely. You can find me on Instagram, Sujay Mehta. So SUJMEHTA. Tap in. A lot of times I'm giving, free information. Feel free to DM me. I'm here to help. So even if you have a quick question, would love to answer it. Just to support. Follow this podcast, because I think Josh is doing some amazing things. This is the information age.
Yeah.
And there's no shortage of information out there. And so, tap into great podcasts like this, and definitely learn, because that's where it begins for all of us. And we never stop becoming students. So
that's 100% for sure. And we'll have your information posted when we release this. It should be tomorrow, the next day. So definitely appreciate it, Sujay. We will talk soon. Excited to see your journey.
Absolutely, man. Thank you so much.
Thanks again. Bye.